While India is now the fifth largest economy in the world in terms of GDP, the fact is that in terms of per capita income, India still ranks one of the lowest at 142nd position out of 197 countries. Today, India's per capita income that basically suggests the average income of a person in a country is around $2,000 a year. That is around 1.6 lakh rupee a year. And there is a long way for Indian economy before it becomes a developed country. And Indian government knows that if India has to grow, its rural population has to grow because more than 60% population in India still live in rural parts. Hence, over the last many years, Indian government has focused on one theme, that is financial inclusion. So in this video, we are going to discuss a small finance bank that is playing a crucial role in financial inclusion. Hey everyone, my name is Sahil and this is my Personal Finance Academy. While Indian government privatized the banking sector way back in 90s, there are still millions of people in India who still do not have access to credit facilities. There is still a huge amount of unbanked population like your farmers, small fruit and vegetable vendors, small kirana owners who do not have access to credit facilities. And for Indian economy to become a developed country, this unbanked population needs to be catered. That is the reason in 2015, Indian government launched a small finance bank category that caters to the underprivileged section of the society. And that's where in today's video, we'll look at one of the leading small finance bank in India, which is Equitas Small Finance. Now, over the last few years, Indian banking sector has struggled due to multiple reasons. In 2016, there was major challenge due to demonetization. And then in 2020, we witnessed COVID that resulted in huge bad loans and rise in NPAs for banking sector. As a result, small finance bank that caters to economically weaker section of the society struggled with high NPAs. However, now the banking sector is in a much better position in terms of asset quality and the growth prospects are looking very promising. So I am going to discuss three things in this video. First, I will explain what really is small finance bank and how it is different from other commercialized banks like your ICICI or SDFC. Second, we will cover the fundamentals of Equitas Small Finance. And third, there is a major change in the shareholding pattern of Equitas, where promoter holding is now showing 0 and FIDI and public holding has seen big jump in latest shareholding data. So we'll try to understand the reason for this. But before that, as usual, this video is only for educational purpose. Make sure that you do your own research before investing your money. Alright, let's get started. So first big difference between small finance and commercialized bank is target customer. Small finance banks were introduced in 2015 with an objective to serve the underbanked section of the population, including your small businesses, farmers, low-income household, which typically don't get loan from commercial banks due to their low income, lack of documentation, or poor credit history. Commercialized bank, on the other hand, serve a more diverse set of customer, including your retail customer, high net worth individual, medium and large corporates, and institutional clients. Then second key difference is regulatory requirement. As per RBI, 75% of loan portfolio of small finance banks should be for priority sector, including your agriculture, micro and small enterprises, and low income housing. They are also required to maintain a higher level of capital adequacy compared to other banks. Small finance banks are required to open at least 25% of their branches in underbanked rural areas. As far as loan rates are concerned, small finance bank charges higher interest rates due to their high cost of capital and slightly higher risk in business as compared to your commercial bank. I hope now you got the difference between commercial bank and small finance bank. Now let us look at Equitas Small Finance Bank business model. Equitas Small Finance Bank received its small finance banking license in 2016. Before acquiring the banking license, it operated as Equitas Holding Limited that started its operation in 2007 in microfinance segment and diversified into vehicle and housing finance in 2011. Then in 2013, it expanded its loan offering with small medium enterprise, that is SME loan and loan against property. Later, it merged with the other two subsidiaries named Equitas Microfinance and Equitas Housing Finance and formed a bank called Equitas Small Finance Bank. If you look at the loan book breakup of the small finance bank as of Q4 of FY23, 19% loan book is microfinance, 36% is small business loan, 10% is housing finance, 25% is vehicle finance, and remaining is MSE finance and NBFC. So over the last 17 years, Equitas has diversified its loan offering and reduced its dependency from 100% microfinance to current levels of 19%. Please note that microfinance loans are unsecured in nature, so that is a high-risk business. Hence, Equitas Small Finance has shifted its focus to other loan categories that are secured in nature. For instance, vehicle finance is secured against vehicle, housing finance is secured against house, small business loans are secured against property as collateral, MSE loans are backed by fixed asset. So Equitas has significantly reduced its risk by making its 81% loan book as of today secured against assets and other collateral. This is a major factor that eventually drive better return on asset and return on equity. Now, before you invest your money in banking and financial sector, it is very important to understand the income statement, balance sheet and key ratios. That gives you a clear picture about the quality of the business. So let us look at Equitas financials. First of all, if you look at the income statement, company's net interest income has grown from 860 crore to 1100, then 1500, 17, 2000 and latest at 2500. So overall, the net interest income has grown at 24.3% CAGR in last 5 years. Next, within income statement, we have to look at the total income that has grown from 1100 crore to levels of 3200. So again, look at the consistent growth in total income that represent a growth of 24% CAGR. Next, if you look at the pre-provision operating profit, it has grown from 220 crore to again consistently at current levels of 1176 crore. Although there was a slight dip during COVID, but overall if you look at the pre-provision profit, the growth is fantastic at 40% CAGR. Next, within income statement, if you look at the provision, company's provision dropped from 18 to 19. Again, the provision increased exponentially during COVID, but now the provisions have fallen to 407 crore. And due to fall in provisions, the income has grown, the profits have grown. Look at this, the profit before tax was just 48 crore in FY18, grown to 323, then to 500 crore, then again it dipped during COVID, but look at this sharp jump, which is 768 latest. So profit before tax has grown at 24% CAGR from 19 to 23. And finally, if you look at the net profit within income statement, it has grown from 31 to 210, and then it did fall during COVID, but look at the sharp recovery from FY22 to 23, and latest net profit is 573 crore, and it signifies 28.5% CAGR growth between FY19 to 23. Next, it is important to look at the balance sheet, where the company's deposits have grown consistently from 5,600 crore to 9,000, 10,000, 16, and latest it is 25,380 crore. And if you look at the CASA deposit percentage, CASA deposit did fell during initial 3 years, but look at this, CASA jumped to highs of 52% and latest CASA ratio is at 42.29%, which is very good. Then if you look at the loan book of the company, look at the consistent growth from levels of 7,100, 11, 13, 16, 19, and latest loan book growth is 25,700 crore. So Equitas loan book has grown at a CAGR rate of 27.4% in last 5 years, and company has guided for 25 to 30% growth in loan book in FY24. Then if you look at the asset quality of bank, asset quality include gross NPA and net NPA. So gross NPA have remained at levels of 2%, and then it spiked during COVID, and then from FY22 the gross NPA has fallen to current levels of 2.76%. Likewise, net NPA were constant around 1.5, 1.6%. It did spike during COVID, but again it has fallen to all-time low of 1.21. So asset quality today is at an all-time best. Then if you look at the business efficiency ratio, company's credit cost did fell down, but during COVID it jumped and now it is at 1.39. This credit cost is further expected to go down to levels of 1.2 to 1.25. And company's cost to total income has fallen from 80% to 60. It spiked and then again it is 63. So cost to income, credit cost, they are very, very important to understand company's underwriting process, and company's cost to income and credit cost are very good. That shows a very robust underwriting process. Next, if you look at the efficiency ratio, look at the net interest margin. It is in the range of 8 to 9%. Latest net interest margin is 8.8%, which is very good. Then it is very important to look at the profitability ratio. Within that, you got to look at return on equity and return on asset. Company's ROE has spiked from 1.6% to 9%. It did fell down during COVID to 7.3, but again it has spiked to 12.2%. Next, if you look at the return on asset, it has also again improved significantly from 0.3 to levels of 1.7. It did fell during COVID, but again it is at 1.9, which is very good ratio. And it is expected to be around 2 to 2.25% in FY24. Clearly, Equitas is growing at a very good rate on all parameters, and its efficiency is also improving with fall in credit cost and cost to total income that suggests a very robust underwriting process. As a result, its profitability in terms of ROE and ROA has improved significantly, and it's expected to further improve in coming years. The strong financials of company are due to a very robust management team leading the business. Mr. P.N. Vasudevan is the founder, MD and CEO of Equitas. Before Equitas, he has 2 decades of experience at Cholamandalam Group, where he was the Vice President and Head of Vehicle Finance. Then Murli Vaidyanathan is the Senior President at Equitas. He has 13 years of experience with Kotak Mahindra Bank, where he was the EVP. Then Rohit Phadke is the Senior President at Equitas. He also has 2 decades of experience at Cholamandalam Group, where he was the President and Business Head of Home Loan. Overall, Equitas Small Finance has a very competent and experienced leadership. So till now we discussed the business of Equitas, its financials and leadership. Now let us try to understand the future growth prospects and key growth drivers. The biggest growth driver for small finance sector is huge untapped opportunity in rural segment. Rural segment contributed around 47% in country's GDP, yet their contribution in credit remains fairly low at around 9 to 10%. There are still many informal credit channels in rural part of the country that offers loans at very high interest rate. Again, that creates a big opportunity to cater to this unbanked population. These small finance banks are also diversifying their portfolio by offering multiple types of loans and expanding their presence in newer untapped geography that again create growth opportunity. More importantly, today these small finance banks have major deposits coming via FD and other term deposits. So there is still a huge scope for raising capital via CASA deposit, that is current account and saving account. That will help small finance bank to lend money at more reasonable rates to customer. This will further enhance their cross-sell opportunity. Finally, the growth of fintech sector might look like a big threat to small finance bank, but it has actually created a great collaboration opportunity to partner and innovate in finance domain. Equitas leadership in their annual report mentioned that we view fintech as complements to our own strength and not as competitors, thereby entering into robust partnership to drive innovation and engagement at scale. Some of the partners for Equitas include Neo, Grow, Frio, etc. Recently, Equitas management has mentioned that they will apply for universal banking license that would further reduce the regulatory requirement and would result in better return on equity. Overall, the future growth prospects of Equitas Small Finance are looking very bright. Now, it is equally important to understand the negatives or key risk. So first key risk is geography risk. Nearly 50% of companies' loan book is concentrated in Tamil Nadu and around 78% of business comes from top 3 states. So geographic concentration is one of the key risks for the bank. Although bank is diversifying its loan portfolio and now has presence in 18 states. However, in the medium term, this is one key risk. For Equitas Small Finance to truly grow in the long term, it has to grow and become a pan-India bank, at the same time maintain its asset quality. Then second risk is NPA risk. Since Equitas cater to underbanked section of the population, including your small business farmers and low-income household, there is always a risk of default. We have seen multiple cases where banks' NPA spiked during demonetization and recently during COVID. Any negative event in the economy could negatively impact the asset quality and bank's profitability. Then third key risk is leadership transition overhang. Last year, Mr. Vasudevan, founder, MD and CEO of Equitas, announced plans to step down from his position. However, later there was announcement that he will continue as MD and CEO. His current term is till July 23, but bank has mentioned that he will continue further for next 3 years, provided they get the approval from RBI. So this is one aspect that could impact Equitas share sentiments. As far as competitors are concerned, although there are 12 small finance banks in India, but nearly 60% of loan book is among 3 key players, including AU Small Finance, Equitas Small Finance and Ujjivan Small Finance. AU Small Finance today has a loan book of around 59,150 crore with a market cap of 48,000 crore and price to book of 6.1. Equitas Small Finance today has a loan book of 25,800 crore with market cap of 8,800 crore and price to book of 2.3. Ujjivan Small Finance today has a loan book of 16,300 crore with market cap of 6,700 crore and price to book of 2.3. So compared to AU Small Finance, Equitas has a much better valuation. Maybe I can do an in-depth comparison of these three small finance banks in separate video. Now finally, I want to touch base upon the shareholding pattern. If you look at the shareholding of Equitas Small Finance, you will notice that promoters' stake in the company has suddenly reduced from 74.48% in December to 0% in latest quarter. Now the big question is, why promoters have sold their entire stake in the company? So the answer is reverse merger. Earlier, Equitas Small Finance promoter company was Equitas Holding Limited. However, recently there is a reverse merger where Equitas Holding Limited is getting merged into Equitas Small Finance. With this, the existing shareholder of Equitas Holding Limited received the shares of Equitas Small Finance. And Equitas Holding Limited had no individual promoter. Its shareholders included FIs, DIs and public. Now after the merger, these shareholders have become the shareholders of Equitas Small Finance. And the list include many marquee investors. For instance, in FI, it includes MIT, Government of Singapore, Vanguard. In DI section, the investors include DSP, SBI, Nippon, Franklin, SDFC, ICICI, Canara Robeco, ICICI Prudential, Sundaram Mutual Fund. So almost all major DIs are holding Equitas in their portfolio. As far as valuations are concerned, Equitas Small Finance launched its IPO in October 20 at levels of around 33. And currently company is trading at levels of 78. Although there is a good rally in last 1 year, but even at current levels, it commands a P ratio of 15 and price to book of 2.3, that is looking decent to add the share in the portfolio. Currently it commands a market cap of around 8,800 crore, so it's a small cap company with immense growth potential in next 5, 10, 20 years. So better strategy would be to make an entry and buy this stock in a systematic manner. Any correction can be utilized to accumulate this stock for long-term wealth creation. As far as brokerage targets are concerned, brokerage houses initiated their coverage post recent Q4 results and all of them have a buy call on Equitas Small Finance. ICICI Security has a target of 100 rupee, ICICI Direct target is 88, Motilal Oswal target is 87. So from current levels, that's an upside of around 10 to 26%. So in this video, we discussed what exactly is small finance bank and we covered the fundamentals of Equitas Small Finance. This bank is growing at a very good rate with high profitability, very good asset quality and bank has a very competent leadership. So it checks all the boxes of fundamentally strong company. As far as future is concerned, the long-term prospect of Indian banking sector are very bright, especially in rural segment. So overall, Equitas Small Finance is looking very promising at current levels for someone with long-term investment mindset. Now tell me in the comment, what is your take on this company? Have you invested in small finance bank? I hope you'll find this video useful. I'll see you in the next video. Till then, take care.